On our radar on that note is EID Parry. The company reported a weak set of second quarter numbers. The one that did well for them was the distillery segment. The revenues grew, but the profitability out there under pressure. So we do have with us Muthu Murugappan, who's the CEO of EID Parry, joining us. Thanks a lot, Mr. Murugappan, for joining in. Distillery, the revenues grew. I presume that is on account of increased capacity out here. So if you could give us a sense of, what the capacity utilization, what the volumes in this quarter were, what are you targeting for the end of this year and next year as well as more capacity comes on stream? And when does operational performance stabilize as utilization increase? So on a steady state, what is the kind of EBITDA that one should look at specifically in your distillery business?
Yeah, Mangalam, very good morning. Thank you for having me on the show. The distillery segment has done well from a volume and throughput basis. Now, this is on the back of, yes, as you rightly said, increased capacity which has come on stream. We are also fulfilling our ethanol commitments. We also have a strong ENA business in Tamil Nadu, and this has contributed towards good growth in this segment. We ran at about, I would say, 80% of capacity utilization. We're starting to see some pressure now, and this is because of lower molasses availability. It's been a tough last 2 seasons in Tamil Nadu on account of poor rains. So this has impacted feedstock availability. So we're starting to see some pressures right now. From a margin perspective, I think we have seen a dilution of margins. We've seen a dilution of margins because of lower recovery on the cane side. Also, I think the ethanol blending policy pertaining to sugarcane-based feedstock took a brief hiatus, and I think that has also put some pressure on the margins. Beyond this, from a sugarcane ethanol perspective, we've seen consistent increases in the FRP. 2 years ago, it was rupees 3050 per ton. It's currently rupees 3400 per ton. And obviously, this raises your input cost. With capacity addition, the fixed cost positions of the industry at large has moved up as well. But unfortunately, we've not yet seen an upward revision in the ethanol price. So this has diluted margins to around 6.5% to 7% at a EBITDA basis. 5 quarters ago, we were perhaps around 16% EBITDA margins, sort of trending towards north of 20. But there's been significant margin dilution in the last 4 or 5 quarters.
All right. Hi, Mr. Murugappan. Good morning and thanks a lot for joining in. This is Nigel on this side. When we chatted earlier, I think we were talking about volumes of around 16 to 16.5 crore litres. Do you stick by that for this year? If you could help us out, what is the volume target? And since margins have got diluted, some part of that could be because of the startup costs, I'm guessing. Do you expect margins to recover a little bit in the coming 2 quarters?
Very good morning, Nigel. I think this year we will sort of move north of 17 crore litres. Okay. That's where we expect volumes to land. Yes, we did have some operational issues as we started up our larger distilleries, but I think that has settled down right now.
So profitability will pick up then in comparison to Q2, right?
I think the real lever, Nigel, as I mentioned a few minutes ago, is the upward revision in price, because you've got cane costs which have moved up significantly, and also a fixed cost position which has moved up. So I think the real lever is the upward revision in the ethanol prices, and I think policymakers are, at least we understand that it's being discussed. I think industry has made some representations. I think the real lever in terms of moving those margins up will be that, because I think your cost positions have significantly moved up on the other side. We will still run our distillery, but at a muted contribution, because we can't. I mean, unless it's negative contribution, then you're forced to, or you don't have feedstock availability, then you're forced to stop. But ideally at positive contributions, you would run distilleries. But we set up all of this capacity envisaging a 20% EBITDA margin over a couple of years. But when you're down to 6-7%, then that significantly delays your paybacks and all of your return metrics.
Mr. Murugappan, good morning. In the con call, you mentioned that white premium, the difference between the price of raw sugar and refined sugar, that is going to come off. Are you expecting the sugar business to get impacted? And if you could quantify that?
So Prashant, that's pertaining to the sugar refinery. It's in an SEZ in Kakinada, so that's an all-export refinery. So it largely imports imports raw sugar, refines and puts refined sugar back into the global market. Yes, the white premiums have come off, and that has dropped the spreads. And white premiums have largely come off because there's been more supply put into the global market from parts of Europe and parts of Asia. So we are seeing a challenging H2 on the refinery business. Perhaps we see spreads now normalizing around the sort of May timeframe. But I think H2 will be a challenging period for the refinery business.
All right, H2 will be challenging for the refinery business as well. Muthu, amidst all of this, the growth driver for the company on a very slow base, small base, would be your consumer division, your CPG business. If you could tell us, what does it stand at right now in terms of a revenue run rate? Where do you expect it to be? And operationally as well, what are the steady state margins? By when do you expect to break even here?
So Mangalam, the CPG business is about 450 crores, a healthy growth of, I think, close to 70% sort of H1 to H1, largely on account of launch of the staples line, which is really dal, rice, pulses, and millets. So this is obviously a segment we are betting on. We've got a multi-decadal view on this business. I think the current run rates will I would say they will continue and perhaps even move northwards of this for the rest of the year. We will continue to invest and grow this business going forward.
Do you have any aspirational target here in terms of how big do you want it to be as a proportion of your overall sales, and by when does it break even since you're investing?
So yes, there are certain internal aspirations, and I will sort of refrain from any guidance here. But I think what we're aspiring to exit the decade with is a substantially larger business, a couple of X of where it is right now, and a high single-digit EBITDA margin, high single-digit percentage EBITDA margin.
All right, very quickly, Mr. Murugappan, before we let you go, if you could help us out with, if in case there's an ethanol price revision, what would your expectations be? What's the wish list according to you? And also, if you could tell us a rough timeline by when you expect this to happen?
So I think the industry at large and the industry bodies have as well, Nigel, made representations to the policy makers. I think it's really hard to say. I mean, obviously, we would have a certain wish list or an aspiration there, but I'm sure the policy makers will have their own views, and we're really hopeful that there will be a good meeting point.
What is the industry's wish list? What is the industry's wish list?
I think the industry, the ISMA has proposed, and this is in the public domain, I think a 4 or 5 rupee increment from where it is.
Right.
We'll have to see where things land. We remain hopeful. The sugar balance in the country is very healthy, and I think it certainly gives room to consider this positively, as well as look at MSP revisions and exports, because as I'm sort of saying again, sector is invested, but I think our returns are well delayed now.
All right, Muthu, thank you so much for joining in and giving us an outlook on the business. Second half looks a little weak, but long-term levers well in place for EID Parry as well.